and my mic. All right, everyone, welcome. We'll give folks a moment or two to sign on. So we'll keep the screen up here and get started in about a minute and a half. Okay. Well, welcome, everyone. This is a webinar today organized by the Department of Energy's Loan Programs Office in partnership with several state energy financing institutions. And we're going to be talking about how state energy financing institutions are leveraging funding from the Loan Programs Office. There will be several presentations today. First, you'll hear from Elizabeth Bellis-Wolfe and myself. We're both senior advisors, contractors at the Department of Energy Loan Programs Office. And then you'll hear from Georges Sassine, who's Vice President of Large Scale Renewables at NYSERDA, and Greg Randolph, who's the Managing Director and Head of Investment and Portfolio Management at the New York Green Bank. Then we'll hear from Bert Hunter, Chief Investment Officer at the Connecticut Green Bank, and Ram Akella, the Managing Director of Innovation Impact for the New Jersey Economic Development Authority. So I will get us rolling. I'm going to talk a bit about broadly two ways that SEFIs can leverage LPO financing. And then my colleague Elizabeth is going to talk about various financing terms, the application process, and meaningful support that SEFIs provide to projects. So here we go. Next. All right, so you're familiar with the Loan Programs Office, and we are financing projects across an array of technologies. And you can, of course, all the information we'll present today is available in different contexts on our website, but there are many pathways to LPO, and we're doing a ton in all of these areas, offshore wind and transmission. And we have different loan authorities, so we can finance many different kinds of projects, and we are. Next. Hopefully going in the other direction this time. All right, great. We have multiple loan authorities. Congress has created multiple loan authorities for the Loan Programs Office. Today, we're going to be focusing in on Title 17 and the State Energy Financing Institution Program. But just to note that there are other loan authorities, and often folks approach us for one authority, but actually the relevant opportunity might be in a different one. So today we're focusing in on the program Title 17, which historically has been for projects that are using an innovative technology, but now will not need to have an innovative technology if they have support from a state energy financing institution. Next. Again, as you know, if a project has investment, and we'll get into that, from a SEFI, it does not need to have an innovative technology as a result of the Bipartisan Infrastructure Law and the Inflation Reduction Act. Next. So what is a SEFI? I'm going to review some concepts we've discussed because I think it's helpful. So a state energy financing institution is an LPO designation. It's in the law. It's for a state entity that provides financial support to energy projects. Most states would have several entities that could qualify as a SEFI. They could be the Energy Office or Administration. It could be the Green Bank. It could be a Clean Energy Lending Center. It could be housing finance agencies, economic development authorities. In fact, we're going to hear from several different types of SEFIs today. So important to kind of understand that. And that's also why we're really not able to just find all the SEFIs in all the states all at once. We rely on the states to kind of come to us. But note that a SEFI is not likely to be a local government entity or an independent nonprofit. It needs to be a state government entity or quasi-government entity. You can go to our website for a partial list. It's not all of the SEFIs that we've determined to be SEFIs, but there is a partial list and we're always adding to it, and we look forward to adding yours as well. Next. Projects that qualify for LPO because they have support from a SEFI need to reduce greenhouse gas emissions. That's an important requirement. They have to have a reasonable prospect of repaying the loan. We often get inquiries about, could we convert a loan to a grant? We have a rigorous due diligence process assessing a project's ability to repay the loan. And of course, they have to use one of our eligible technologies, although we are now able to really focus on deployment and commercialized technologies through this program. It does not need to just be innovative technology. Next. So a way to think about it, if you're a project developer, you might talk to state agencies that have a nexus with your project and find out if they are considering investing in the kind of project you're working on. And then you can work with us and we can ascertain whether that agency or quasi-government agency could be a SEFI. Or if you're a state government official, you might consider all the ways that your state government is supporting energy projects and whether those different resources across different agencies, which of those might also be appropriate to utilize as SEFI support. Most state governments will support energy projects through different agencies, so we can review that with you. Next. Okay, so first we're going to talk a bit about the straightforward way for a SEFI to back projects as the investor in the project. So a state agency could make an investment with one project, one big project that matters a lot to that SEFI, and that project can then come borrow from us. Or a SEFI could create an awards program where the SEFI puts out to the private sector and also even to other levels of state government, municipal government, that they can back projects. The SEFI can back projects, and you can design a funding awards program so that projects can efficiently apply to LPO. So we're going to hear about programs like that today. If you want to pursue that path, some of the advantages of that are that it helps you find projects in the private sector. You can do contingent awards where projects, you might say that projects ultimately have to be determined, they have to get a commitment from LPO. Projects would apply to both. So we can work with you on all of those elements if that's the path you'd like to take. Next. Delving a little deeper. When you are making awards to projects, things to understand about that is that you're helping large projects qualify for LPO with SEFI financing, but that wouldn't necessarily help small projects. And there's some practical realities as to why LPO finances large projects. If you are making awards, you're not the borrower. So your exposure is based on the nature of your award. You're an investor in the project. It might be a loan, it might be mezzanine debt, it might be a grant. Your exposure is limited to the amount of your award and the terms of your award. So sometimes we hear from states, well, if we want to do this, are we taking on a debt obligation of the project? You're providing an award to the project, and that's the extent of your participation. However, there is a second approach that has advantages, and there are many states that are considering, and that is bundling projects together, smaller projects, and then putting a special purpose vehicle or having the SEFI come in itself to borrow money in order to allow that SEFI to finance smaller projects. So there are many considerations there, but that is a way that a state can leverage LPO for smaller clean energy projects. Next. Just as a visual, and this is very simplified, but when the SEFI is the investor, you have LPO is the maximum we will lend to is 80% of the project cost. It might be less. So that project is going to have private equity and sponsor equity. It's going to have a SEFI investment, and then it would have an LPO guaranteed loan. So that's when the SEFI is the investor. Next. Alternatively, if the SEFI is the borrower or the special purpose vehicle, you still have the requirement for equity capital. The SEFI might organize that capital, though. It could provide it or it could organize it. And of course, there's a blending there with the meaningful support contribution. So if the SEFI is the borrower, then the SEFI has to come to the table with that equity share identified. Next. Okay, I'm going to pass it to my colleague, Elizabeth Bellis-Wolf.
Thanks, Hans. We're going to dive a little deeper now into what meaningful support from a SEFI can look like. First, some examples of the types of support. Equity and subordinate portions of the capital stack can constitute meaningful support, as can pari passu lending with LPO, mezzanine lending alongside LPO, various types of loan loss reserve, and backstop structures. Key thing to hear here is it's got to be financial support. Not all types of support will meet our requirements. And a couple of specific types that we have had to consider and that generally won't constitute meaningful support include state renewable portfolio standards, where the awards aren't flowing through the budget of a state agency or aren't borne by the relevant SEFI, but instead may be borne by a utility or another third party. Certain property tax exemptions or abatements where there's not a direct project-specific award through a SEFI. Both of these are examples that may not constitute meaningful support. Next slide. We recently, I think yesterday, put out a new blog post describing the factors that we take into account at LPO in determining whether SEFI support is indeed meaningful. And we've identified three primary factors. First, the overall amount of the support. Second, the level of risk that the SEFI is taking. So although we can look at support on any level of the spectrum from full-on grants to pari passu lending, more risky support is considered more meaningful at the same dollar amount. And finally, the terms on which the SEFI support is offered. If a SEFI is offering below market terms, that may impact the meaningfulness of support at a particular dollar amount. Next slide, please. More generally, our SEFI projects are usually coming in under Title 17. And this slide just provides a quick reminder and overview of the terms applicable to all Title 17 projects. A couple things to highlight here are the fact that there are a number of federal requirements, including NEPA and Davis-Bacon and cargo preference, that generally do apply to our projects. Happy to talk to you further about what that means for any particular project you're considering. We offer guarantees both of Treasury loans and of third-party loans. The amount of the guarantee depends on the type of lender. We can only provide a maximum of a 90% guarantee for third-party loans, whereas we are required to guarantee 100% of federal finance bank loans. Also note you don't have to apply separately for a federal financing bank loan. If you apply to us and indicate that you're seeking a direct loan for your project, we handle that process internally. We often are asked about interest rates and fees. Again, this isn't SEFI specific, but just high level. Our base cost of capital when we're dealing with an FFB loan is the applicable Treasury rate for the tenor established at the draw, plus a 3/8 or 0.375% liquidity charge. And then depending on the riskiness of the project, we may charge an additional spread or charge on top of that base cost of capital. There are no longer any application fees, but there is a facility fee due at or before financial close at about 0.6% of the committed amount. And there's a maintenance fee that can range up to $500,000 a year post-closing, depending on the intensivity of the project for our portfolio management team. One thing to note, while the costs, third-party costs, such as independent engineers and lawyers, are generally considered eligible costs that can be drawn down from the LPO-supported financing, these fees, the facility fee and the maintenance fee, cannot be financed through that obligation. Let's go on to the next slide. For more detail on all of this, we really encourage you to take a look at our program guidance and application instructions online. It has the more detailed, nuanced version of what we're addressing here. But for example, let's go to the next slide. You can see here, looks like on page 37, there's details on the various fees and expenses. And this is where we note that our independent advisors typically cost $1 to $3 million, which is a question we often get asked by folks considering working with us. Next slide. Similarly, here is a interest-based or credit-based interest rate spread chart that gives you an idea of how it looks based on the riskiness of a project. We can consider requests to cap, reduce, or even waive these charges for projects that align with our policy considerations to the extent that we have appropriated funds available. So please do talk to us about it. But just to give you an idea of how that math works for modeling purposes, this is a good place to start. Next slide. A few quick additional considerations that we also often get asked. A lot of these projects have tax credits, tax benefits. If the project is otherwise entitled to such a tax benefit, it's probably not going to trigger our federal support restriction, even though we generally can't support projects that receive directly or indirectly other federal support. This is a very important exception for this universe of projects. We do require community benefit plans to demonstrate plans around labor and impact on disadvantaged communities. And if you are a nonprofit or a governmental borrower, please be aware that Build America, Buy America requirements around domestic sourcing of equipment and materials do generally apply unless a waiver is obtained due to unavailability or excessive cost of domestically sourced materials. So that's one thing to consider as you're thinking about how to structure your program. Projects are usually at least 100 million. Our applicants tell us that it generally doesn't pencil because of transaction costs below that amount, even though we don't have a specific minimum on our end. And finally, although we traditionally use project finance structures and approaches, we can use corporate and asset-backed approaches as well. So please do reach out to us so that we can talk through your particular project. Next slide. Just high level, this is kind of what your interaction with us will look like on your project. You can request a pre-application consultation with someone like Hans or me to help discuss any questions you might have, answer some high-level eligibility concerns, and that sort of, and also provide feedback on your draft application as you work on it. Then you can submit an application under Title 17. It's a two-part application. You'll be invited to the portal once we've presented your project internally and receive feedback to help you provide the strongest application that you can. The first part really gets into, is this eligible? Does it have enough SEFI support? Does it have innovation? Is it based in the US? Will it reduce greenhouse gas emissions? The second part has to do with the project viability, the prospect of repayment. Once those two steps are passed, then a project can be invited into due diligence, at which point third-party advisors are engaged and some of those fees that we discuss come into play. At the completion of due diligence, we can offer a conditional commitment signed by the secretary. That's a very long-term sheet. And once the conditions to that commitment can be demonstrated to have been met, then we can proceed to financial close. Post-close, LPO stays involved monitoring the project and reviewing regular reporting received from the applicant. So without further ado, I think we can turn it to the next slide and over to some of our partners today to talk about how they're working with us. But again, just please feel free to reach out to us. We're here to work with you on your projects.
Excellent. All right. Our next presenter is George Sassine at NYSERDA, joined by Greg Randolph at New York Green Bank.
Wonderful. Thank you, Hans. Thank you, Elizabeth. We're very excited to be here with all of you today to talk about our partnership between the state of New York, specifically NYSERDA, and the Loan Program Office. If we can go to the next slide, that'd be wonderful. So, I'm here today to represent the state of New York. If you're not familiar with NYSERDA, it stands for the New York State Energy Research and Development Authority. We're the equivalent of the Clean Energy Office for the state of New York. And we also have my colleague, Greg Randolph, who is a managing director at the New York Green Bank, which is a division of NYSERDA, and it's a $1 billion state-sponsored investment fund, which provides market rate capital to support clean energy and sustainable infrastructure projects in the state of New York specifically. My name is George Sassine. I'm the head of the large-scale renewables portfolio for NYSERDA. And excited to be talking to you today. If we can go to the next slide, please. To start the conversation, I just want to put things a little bit in context first. And our work at NYSERDA is driven to implement the New York Climate Act. And the New York Climate Act sets a mandate for New York to reach 70% renewables by 2030 and a zero emission grid by 2040. And a few weeks ago, New York's Governor Kathy Hochul released a comprehensive action plan to reinforce New York State's dedication to clean energy. And in this document, we provided a 10-point action plan to expand specifically on New York's large-scale renewable energy industry. And as part of these set of actions, we highlighted the importance for New York State to leverage federal support and partnerships like the ones that we're discussing today. So if you can go to the next slide, please. Basically, one of these initiatives that we've been working very hard on and are proud of is this memorandum of understanding that NYSERDA entered with the DOE Loan Program Office on September 28th. You can access the actual MOU document to read it yourselves. It is published on the LPO website as part of the blog post announcing this MOU dated September 28, 2023. And so what this partnership does between NYSERDA and the DOE Loan Program Office is it's a non-binding MOU, but it basically enables us to define a process to facilitate the review of applications from utility scale solar, onshore wind, offshore wind, clean energy projects that are applying for financing to the LPO. And this is specifically for projects that are under contract with NYSERDA or those that will have a contract with NYSERDA in the future. And I'll talk about that nuance in a minute. But all in all, we're very excited about this partnership, and we really hope that it would enable clean energy projects in New York State to access alternative financing options. Specifically, I think it's very important for us, considering the current inflationary and high interest rate environments that these projects are operating in. If we can go to the next slide, I would like to talk a little bit more about what is NYSERDA's role and what type of support we would, provide to different projects. So I think the first question is, what type of projects and what type of large-scale renewable technologies would qualify? And the short answer is anything within the New York State Clean Energy Standard portfolio. But to simplify it, obviously offshore wind would be its own category, and any project under the land-based utility scale renewables, so solar and onshore wind and others. It does apply to existing contracts with NYSERDA. And for future solicitations, I know we have a couple expedited RFPs live on the street right now. So that was not included in this set of RFPs, but for the RFPs that we're going to be launching next year in 2024, both offshore wind and land-based renewables, we're going to be instilling a new process as part of the application process to submit new data, and the intention for these projects to apply for a loan from the LPO. So we will be setting up that process in upcoming solicitations starting in 2024. But in the meantime, the rest of this conversation also is going to be focused on existing projects that have contracts with NYSERDA that would like to take advantage and would like to of that MOU and that process. And I think, like Hans mentioned earlier, I think there's a couple ways for applicants to think about this, whether it's an individual project that has a contract with NYSERDA, or an SPV, like Hans mentioned, but or a portfolio of projects that have contracts with NYSERDA. I think that's an important nuance to highlight. And so through NYSERDA and the New York Green Bank, there's two levels of assistance that we would consider providing for these projects. The first one is data room collection assistance to facilitate, the application to the LPO on behalf of the applicant. And the second one would be the New York Green Bank would consider a SEFI participation to support the projects. So before my colleague Greg Randolph from the New York Green Bank gives you a bit more details on these two types of assistance, I just want to highlight a couple of things. For land-based renewables, there will be a need for a SEFI. And the New York Green Bank could participate in a small portion of the financing to meet the SEFI obligation. And like I said, it could be applied on a project-by-project basis or on a portfolio of projects. For offshore wind, there may not be a need for SEFI support. The eligibility under the SEFI provision waives the usual requirements if it meets the innovation requirements, which means that if a project demonstrates that they're using a new or significantly improved technology, that project would meet the innovation requirement and may not need SEFI support. Now, in the case for offshore wind where the SEFI participation is required, the New York Green Bank would still consider to participate in a small portion of the financing in order to meet the SEFI qualification. But I'm gonna pass it on to my colleague Greg Randolph, that's going to walk you through a bit more detail on these two different forms of assistance.
Thank you, George. Thank you, George. Next slide, please. So George referred to a couple areas where the New York Green Bank would be happy to work together with NYSERDA and with applicants here to facilitate LPO financing. One of those areas would be in data room collection. The New York Green Bank is a $1 billion state-funded institution. We have about 40 employees. Most of our employees here are familiar with project finance structures. We work with them on a regular basis. And in that context, we're happy to work with applicants for LPO financing involving New York State projects and helping them to collect the necessary information that the LPO would require in order to consider financing. And this typically involves, collecting things on this page, like the financial model, any NYSERDA award documentation, the underlying project contracts, EPC agreements, equipment contracts for equipment, site control documents, things of that nature. Permit schedules become quite important in these projects. What permits do you have? What's the schedule for the permits that you would need to require in order to facilitate financing? Obviously, the construction schedule and the associated EPC agreements. How long would the project take to build? Who would build it? What's the anticipated funding requirement over the term of the construction period? Things of that nature that the LPO, as a lender would need to evaluate. And then likewise, the overall capital structure here. What is the overall funding need? Where is that money going to come from? What equity is going to be put into the project? Where is that going to come from? What sort of completion obligations do various parties have? And we'd be happy to work with people to help facilitate getting this information to the LPO so that they can do the work that they need to do to consider financing for your project or group of projects. Next slide, please. As George likewise indicated, the New York Green Bank was capitalized with $1 billion of ratepayer money back in the 2014 timeframe, and we made over $2 billion worth of commitments since that time, and we do qualify as a SEFI. And we'd be happy to participate as a SEFI in any New York State LSR project where that commitment would be helpful to facilitate the financing from the LPO. We could consider that either lending alongside the LPO in a financing. We also could consider a mezzanine structure if that is required, or if that is better suited to the overall capital structure. The typical transaction that the New York Green Bank participates in is $25 to $50 million in size. We do have a soft cap on our commitments at about $100 million. So we would simply want people to have that in mind as we consider any particular participation. I'll turn it back to George and suggest we go on to the next slide here.
Thank you, Greg. I just want to highlight and clarify one item and have like a small disclaimer. Obviously, like I said, this MOU between NYSERDA and the LPO is a non-binding document, but it's a reflection of the effort that NYSERDA has been putting into understanding the LPO's Title 17 program, and the effort that we're willing to put to support projects that have contracts with us in New York. But there's an important nuance to make, though, that this MOU does not reflect a commitment by the LPO to review or process applications on a specific accelerated timeline, because we've been getting a lot of questions about this. The nuance that I want to underline here is that the intent is that NYSERDA and the New York Green Bank, providing some sort of support to prepare potential applications for the LPO process may result in applications being better prepared for the application and evaluation process with the LPO. So it's an important nuance that I do want to underscore. And as you can imagine, I think that the SEFI participation, I think, is a major one from our perspective, which we would think would really support projects to go through that process. So what are next steps and how to work with NYSERDA on these two items? With regard to, and again, I think that that process for the data room collection assistance is going to be different in upcoming solicitations, but projects with existing contracts, this is the process that we've put in place. So the first thing to do would be to reach out to NYSERDA specifically for the offshore wind projects. It would be to Laila El Ashmawi, which you can see her email on the slide. And with regards to the Tier 1 land-based renewables portfolio, please do reach out to Natalie Simos, which you can see also her email on the slide. And what the process would look like is that these first points of contact would do an initial screen on the interest that's incoming. We would share with you a checklist that we would have developed on the data room collection assistance for your consideration. And then in order to move forward, there would be a need to sign a very standard short disclaimer for NYSERDA and your Green Bank's assistance. It's basically a disclaimer that releases NYSERDA and the New York Green Bank from any liability which participants would need to sign. And then after that is done, and we would move very swiftly through these couple steps, we would put you in touch with a specific point of contact at the New York Green Bank, which would be supporting you through that process. Now, with regards to the SEFI participation piece of it, there is an already established process at the New York Green Bank called the RFP number 1, where you would have to submit an application, and you can access that on the Green Bank website and go through that process to start the conversation on the SEFI piece. With that, I don't know, Greg, if you would like to say anything further on this part.
We would welcome the chance to work with you on any New York State project. If you have a question with respect to RFP 1, which is just our request for financing that anyone might have, please feel free to reach out to me. The best way to do that is via email. And the RFP 1 is not intended to be at all an onerous process. It's meant really to be off the shelf information, about a given project, the expected funding need, and the associated management of the project. That's really all it's meant to be. It should be off the shelf information that someone would be able to submit through our RFP 1. Thank you.
I just want to say thank you all, and thank you to the wonderful team at the LPO and your dedication to supporting the clean energy industry. I think all of us do need your support in this environment, and can't thank you enough for all the work that you're doing. Hans, back to you.
Thank you, George, and thank you, Greg. Bert Hunter is the Chief Investment Officer at the Connecticut Green Bank. Bert.
Thank you, Hans, and that was a great presentation, George and Greg. So good to be with you today from Connecticut Green Bank. We are the first green bank, as many of you know, established in 2011. You can go to the next slide so we can move things along. Wait for that to advance. Our mission is to confront climate change by increasing and accelerating investment in our economy here in Connecticut, our green economy. And we are a staff of about 55 people. We're under the leadership of our president and CEO, Brian Garcia. Next slide, please. This is basically how a green bank works. Yeah, a number of you are possibly familiar with this, but really we take our public funding, which is kind of that green stack of bills there. Sorry, the purple stack of bills, and mix it with private investment, all the green bills. And so we achieve a leverage ratio, meaning how much private investment we can raise versus our public investment of between $6 and $7 for every $1 of our public funding. And that all produces all the benefits that you see at the bottom of the screen. Importantly, deploying clean energy, reducing greenhouse gas emissions, and creating green jobs. Next slide, please. We're organized around 4 verticals. Home solutions, meaning basically residential as well as that includes single-family homes and multifamily. We also do building solutions for commercial and industrial, as well as for nonprofits. Community solutions, we work with a number of municipalities as well as our friends at the state level in order to develop and deploy solar projects, microgrids, anaerobic digesters, things of that sort, and investment solutions where we work on larger projects such as fuel cells and hydroelectric facilities. All of these are in support of our state goals to scale up the investment of green investment in our state, achieve our state's environmental impact goals, and to pursue those strategies while creating an environment that leads to our ultimate sustainability. Next slide, please. And what is this translated to in terms of impact? Well, it's been considerable. $2.5 billion of impact over the last 11 years, and that has been done with about $360 million of our funding, which gives you that leverage ratio that I mentioned earlier. Almost $30,000 of jobs. Sorry, 30,000 individual jobs, and the greenhouse gas reduction goals that have been achieved there. Public health benefits are really something I think are understated, but really should be emphasized. The extent to which we're eliminating greenhouse gas emissions and other particulate matter in the atmosphere, really helps to improve the public health, which is bottom line savings in terms of dollars. All the health effects of asthma and cardiovascular events are reduced and produce considerable savings, both in lost time in school and work, as well as direct costs of seeing someone in an emergency room. And then you also have, importantly, energy burden considerations. Most of us in moderate income, median income, and so forth are spending about 3 to 5% of our incomes on energy. When you get into lower income cohorts, that skyrockets to 15, 20, 25%, and that's excluding the cost of energy for transportation. So the extent to which we can help working families deal with that through our programs is very important to us, as well as maintaining the competitiveness of businesses within the state by lowering the cost of energy. There's also a fiscal impact, and you see the numbers there. Next slide, please. And this is really how we interact with the market. The first column there about incentives is really limited, and it's very technology specific. For about a dozen years, the Green Bank ran the Residential Solar Investment Program, where we administered solar incentives for single-family homes. That's something that the Connecticut Clean Energy Fund did in the years leading up to the formation of the Green Bank, and nowadays that has been transitioned over to our investor-owned utilities, Eversource and Avangrid. And now what we're doing is we're focused on a battery energy storage solution program where we allocate incentives upfront for those investments, and we work in concert with Eversource and Avangrid on that, and they provide incentives over the life of the project for about 10 years. But typically, we're really about financing, which are the next three columns. We'll do co-investment with private capital for project development. That is achieved through something called our Green Bank Capital Solutions Program, which is similar to the RFP number 1 that Georgian and Greg just mentioned in New York Green Bank. Credit support, we will offer guarantees, loan loss reserves, and we do that regularly through our Smart E program, where we work with a network of community lenders to provide energy efficiency and solar financing for single-family homes. The third category is aggregation of smaller projects, and that's where we will originate the transaction under our portfolio, and then we'll wrap that portfolio and issue and push those out the door and refinance those transactions. So that's what we do for CPACE. We do that for a program called Solar MAP, which is the Municipal Assistance Project, as well as a state agency projects on the solar side. So we aggregate those projects, and then we arrange for the project development as well as financing, long-term financing for those projects. Next slide, please. That kind of brings us to the SEFI program here and how the pathways of developers into the Green Bank are really achieved. The first one is really we're really operating under an option one pathway that Hans explained earlier, where it's really taking a project approach, and we're working with a number of existing relationships that have been financed by the Connecticut Green Bank over the years. Some of those are, as you see here, can't disclose names, but really a couple of national solar and battery storage third-party owners, two different phases of development there. One's really close to maybe securing financing, which could close in 2024. We're very excited about that. And then we've got a national energy efficiency installer, which is in part one of its application, and we hope can cross the finish line sometime later in 2024. The other pathway is we get inbound transactions from other green banks. Now, it's very limited right now because the program is just getting started up, but we hope that that will improve over time. We are working on a fintech EV car loan program with another SEFI that is leading the way on that. And the third pathway is by supporting state energy and grid initiatives. You see a few of them here. Advanced Metering Infrastructure, or AMI, presents the opportunity to lower the cost of capital in the utility capital structure when they're building out the AMI network. So we're going to try to see if we can pair up with the LPO on a SEFI transaction there. Offshore wind, I won't repeat what was said by Georges there. Energy storage solutions, I mentioned that our battery storage projects, we're really looking for some innovation there, and seeing what we can do to support OEMs and third-party owners in doing business in Connecticut with a SEFI that's supported by our upfront incentives, which can be part of the meaningful support, since those incentives flow through the Green Bank to the projects. Next slide, and I think this is my last slide. So just some high-level considerations about how we're approaching this. Yeah, really, if you want to propose a SEFI transaction similar to the New York Green Bank, they have their RFP1. We have our program called Capital Solutions. We would suggest that you just go to our website and apply through that portal. That will start a conversation with us, and then we can walk you along from there. In terms of level of support, we're talking about putting up somewhere between $5 million to a maximum of $25 million. Keep in mind that our net position as a green bank is about $140 million. So our ability to do multiples of $25 million investments is going to be severely limited. So if you're thinking about that much, get to us soon, because we could be tapped out. But we will be doing a series of 5 to 10 million transactions we expect as we move ahead. We're going to be looking at Connecticut benefits that you see there, additionality, is going to be very important, meaning demonstrating that but for this program, the sponsor wouldn't be able to do this transaction, or they can do much more of it with the SEFI program or at much greater speed and impact. Regional and national benefits. We want to partner with other SEFIs throughout the United States. Connecticut is a small state. We need to pair up with others. So we're actually working on transactions now with a couple of other SEFIs, and we expect to do more in the future, but not all green banks operate the same way. What Elizabeth said about meaningful support being financial support, not all green banks are capable of writing these checks, or at least not yet, so we have to work out some of the kinks in that. And there are also programmatic details with LPO we need to sort through. So, but we've got an ongoing conversation with Hans and Elizabeth and others in LPO on the SEFI program, and that conversation has been working out very well for us. So that takes me back to Hans, and thanks very much. Appreciate having the opportunity to talk today.
Thank you, Bert. And now Ron McKellar from the New Jersey Economic Development Authority.
Thank you much. Hello, everybody. I'm Ron McKellar, Managing Director for Innovation Impact at the Economic Development Authority of New Jersey. Albeit an economic development authority, we've been very supportive and active in climate change initiatives. And to that end, our current commitment or portfolio of products to address climate change in the state add up to north of 700 million, which we will be deploying over the next several years. Next slide, please. I mean, keeping with the commitment of climate change, I mean, historically speaking, if you look at the GGRF guidelines of the goal of reducing emissions somewhere between 50 and 52% relative to 2005 levels by 2030. I mean, the great thing is New Jersey, as of end of 2020, is already 31% below 2005 levels. And all of that to date has been funded from funds within the state, as opposed to anything from the outside world, so to speak. And to that end, we had just been awarded, as part of our fiscal year 24, seed capital to stand up our New Jersey Green Fund, or Green Bank, whatever we're allowed to call the entity, as a subsidiary of the EDA. As I speak now, currently we have 3 distinct programs very much targeted around the state's strategic goals. At the EDA, that's one of them is called NJ CELS, stands for Clean Energy Loans. The NJ ZIP program has been around for a couple of years. It's a voucher program to alleviate acquisition cost of medium to heavyweight trucks in the state, and transportation being the largest pollutant. And we just recently launched our pilot, or will be launching our pilot around a building decarbonization fund we're standing up, as buildings tend to be in the state of New Jersey, the second largest polluting category. Next slide, please. As part of working with the LPO, we've had phenomenal discussions back and forth, and continuing our discussions with Hans and Elizabeth, and they've been terrific to work with. We deem that as we're setting up our green fund, that we should really be pursuing LPO parallel processing, an opportunity with the LPO. And to that end, we decided to issue a request for expressions of interest, or an RFEI, where we're looking to seek expressions of interest from parties that would like for us to support them and certainly work with the LPO. And and clearly they wouldn't have transaction size, or most of them would not have transaction sizes of 100 million or more. So this is a process whereby we can facilitate smaller borrowers at smaller loan limits to tap into the EDA, so that we can work with them and collectively work alongside the LPO. We launched it, and provided here for you all is the link to the RFEI. The EDA is very much committed to climate change, as I said, in the state, but to that end, we support all projects that are within the state, and obviously any companies in the state that are broadly part of the value chain, albeit that the projects may be outside the state, because to us, climate change is a universal objective, not just limited by boundaries. The RFEI is, I guess we're waiting for responses. The deadline to submit these responses to us is by July 12th, or pardon me, January 12th. But the objective here of the RFI is really for us to get feedback on what are the structures borrowers are seeking, where are they feeling the pain points in terms of seeking capital, what size, what is the sort of the bite size that they would like, et cetera, so that we can truly stand up a portfolio of products and financial offerings that cater to a broad sector of the stakeholders. And the respondents we're seeking some interest from are obviously developers and operators of renewable energy, building owners and property owners, real estate developers, various financial institutions that would like for us to participate, or corporations. As part of the EDA, we have a lot of venture investing activity as well. And to that end, we would love to work with all the venture groups or private equity groups that are active in the renewable energy space, or broadly clean energy space, not just from generation, but technology as well. And everything at the EDA that we do has a keen focus on environmental justice communities, right? And every program we have specific adders as extra benefits for overburdened communities, women-owned or minority-owned businesses, or veteran-owned businesses, or projects, et cetera. Next slide, please. So I'm not going to take you through all of that, but clearly we have kind of laid this out very clearly in terms of how we're going to process the submissions post receipt of responses. We'll work feverishly toward finalizing what the portfolio of products and the applications would be, what the application process itself would be, et cetera. And in that regard, we're going to fine tune how we could work with the LPO. The objective of the RFEI is also to aggregate smaller loan sizes so that we get an efficient execution at the LPO level of 100 million or greater. And to that end, as Hans had pointed out earlier, it could be through an SPV structure, or prospectively we step in as a direct principal to this, and then syndicate it out to, or break it up into smaller loans. And part of the effort here is to standardize the terms and conditions of these loans, so that as a portfolio it would be easy for us to syndicate it out or find liquidity through other sources such as a securitization and what have you, so that we could do a few things. One, we could either repay the LPO loan faster, or we could rotate that capital over the duration of the borrow multiple times. These are all ideas that we're working through. These are all, nothing is etched in stone, but just kind of articulating how creative we're trying to be to work with the LPO and certainly all the stakeholders within the state or other parties who have an interest in clean energy in the state. Furthermore, we do believe that there is an opportunity to pass through significant capital costs or cost of debt efficiencies on a aggregated basis. So it's providing access is one for smaller borrowers. Two, it is providing access to a lower cost of debt for smaller borrowers and large ones equally. But that's really the goal, all geared initially around building decarbonization, transportation, clean energy generation, and certainly any new technologies that come in. Our participation would be either as a co-lender, a first loss guarantor, or any such other financial product that we would have to stand up. And that is really going to flush out post the RFEI process. So we're very active. We urge companies that have projects in the state or companies that are in the state as part of the value chain to reach out to us now, so that we can start dialogue and start executing as efficiently and as quickly as possible. Thank you. Hans?
Fantastic. Thank you. That was terrific. All of our presentations were terrific. We're going to close up now. I'm sorry we're not going to be able to take questions from the audience, but just want to say that whether you're an applicant or a state government official, we're here to work with you. And a lot of times with federal funding opportunities, once the funding opportunity is out, the agency really can't engage with you. But in our case, it's different. If you are a prospective applicant, we will provide you with feedback on your application materials. If you're a state government leader, we will provide feedback to you about your strategy and help you build the strongest program. So that's why we're here, and we're really looking forward to hearing more from you. Thank you to all of our participants. You heard some great different models about how states are partnering with us, and we look forward to continuing this great work together. All right, this webinar will be available recorded on our website, so you can go back and pause for those emails and so forth. So thanks, everyone. Have a great rest of your day. Appreciate your participation. Take care.